Good morning, everyone. I, CA Bhavna Grover from Editorial Team Taxman. I'm very pleased to welcome you all in today's session on important changes and key issues for Bank Branch Audit 2022. Our speaker for today's webinar is CA Anil Kumar Saxena. He is a practicing chartered accountant since 1984 and has gathered a wide range of experience in the central statutory audit of public sector, private sector, cooperative, and regional rural banks. He has been very active as a chairman and speaker, convener, and member of various professional bodies and committees. He has delivered lectures on various forums as a speaker on bank audits, accounting standards, standards on auditing, CARO, Ind AS, company law, and other topics of general interest. He is currently on the panel of technical reviewers with the Quality Review Board and also the Financial Review Reporting Board of ICAI. Now I request sir, please take over the A very warm welcome, sir.
Thank you. Thank you, Bhavna. Good afternoon, everyone. At the outset, I think I need to thank Taxman for giving me this opportunity to address the members who've registered today on a very important issue because I think a number of members would move out in a day or two to after the allotment process is over for carrying out the branch audits. And today we've chosen, just the important changes which have occurred since the past 1 year, the regulatory changes made by the Reserve Bank of India. And together with that, I'm also planning to take up certain key issues, more with respect to the IRAC norms. Quickly, let's run through what is the agenda we have today. Other than the changes during the year, most important of which during the year was the RBI Master Circular of 1st October 21, which replaced the earlier Master Circular of 1st July 2015. Together with this, I have also put in, instead of key issues, because issues can be many, what I've done is I've chosen certain checklists, a partner level sign-off checklist, just a few of them other than what you normally do during the course of your audit as guided by the Institute in the guidance note and other standards on auditing, etc. Before we start, a disclaimer that, whatever I would be, what opinion I would be giving during the course of the next 90 minutes are purely my opinion, and they would not be either the opinion of Taxman or my firm Agarwal and Saxena. Let's get rolling and let's start the introduction part. Now, just to give you an idea of, what you are in for once you reach the branches, it should give you a comfort that, as compared to the year 2018-19, where the gross and the net NPA ratios shot up after the AQR by the Reserve Bank of India, the gross NPAs have generally been stable, and as you can see, at least the public sector banks and other banks, it is at a level, the gross NPA is at a level what it was last year. Unlike most of the expectations, people expecting that, post the two frameworks of resolution framework 1 and 2 because of COVID, past the moratorium period, one would see a spate of NPAs, evolving. But then that has not happened. Probably, the economy has picked up more than what we expected. So that's a good sign that, we would not have too many NPAs being reported. So similar is the position of the net NPA ratio. And as you can see, these are figures from the Reserve Bank of India. So the growth also in the NPAs, the gross NPA and the net NPA has been under control. When it comes to the quarterly slippage ratio, again, during the current year, if you see 2021, of course, 21-22, the figures are not complete. But last year, 2021, the quarterly slippage ratio was much below the earlier years. The PCR, which is a very important parameter in most banks, is generally healthy when it comes to public sector, private sector, foreign banks, and all scheduled banks. I mean, it's hovering around 70%, which is what Reserve Bank looks at. Now, this is one thing which I think, all of us need to be very careful about, both the Reserve Bank and also the institute, when it comes to laying stress on certain issues. I think early warning signal and identification of fraud, at least frauds which are accounts which are susceptible to frauds. The Reserve Bank of India looks upon the auditors and other management professionals to identify them at an early stage. So, but then if you see during the current half year, we had the number of frauds reported has increased as compared to the FY 2021. However, in terms of value, it is much less. It's only around 36,342 crores. When we put it in those numbers into averages, etc., you would see that during the past year 2021, not 21-22, because the year is not complete, we had literally around 229 banking frauds per day. So that's a real big figure, and especially when it could be one of the branches where you or I would visit. During the current half year, as you can see, luckily the amount involved is 36,342 crores as compared to nearly double, 64,000 crores during the past year. But the number has gone up. So if the number has gone up, we would need to be careful and vigilant once we visit the branches. Of course, there are guidance. I'll help you out in that. Now, what made news during 2022, which you should prepare us for the branch audit during the current year? Most important is the first bullet, which is the RBI Master Circular of 1st October 21, which got changed after, so literally after 1st July 2015, when we were used to seeing the same Master Circular year after year. You have a new Master Circular with not too many changes, but then some fundamental changes which I'll discuss. And then most importantly, one should remember as auditor that, we are the first professionals who are picked up for any fraud, diversion of funds, or anything which happens in the news. Like, if you see any fraud which is being reported, the first thing, the reporters, the general public would ask is, what were the auditors doing? Now, this is, of course, that's a different subject, which I think, all of us need to discuss. But then, if that be the case, we need to be prepared. We need to be documented. We need to have the evidence with us. We need to have everything in our files to ensure that, in case such a situation does arise in respect of the branch you're doing, you are protected to that extent with the documents you have in your file, so that if there is an inquiry of sorts, you are able to reply back with assurance. Now, the main thing all of us need to remember as branch auditors or as bank auditors, even if you're a central auditor, is that this is one audit where it is re-audited by the regulator. So generally, if you're doing a small company and if you're not covered under the FRRB or the QRB or the NFRA, you would generally sign off a corporate account and then it gets uploaded on the MCA. But this is the, when you're doing a branch audit, even if it's a very small size branch of, let's say, a 25 crore branch, you would still, there is a possibility of your accounts being picked up by Reserve Bank, because it's not unlike the earlier manual period when, it was the RBI inspectors under Section 35 would visit selected number of branches, maybe around 50 of them, and then pick up accounts at that particular branch. Now, ever since, the core banking solution has come in, the Reserve Bank team generally picks up the data, imports the data from the head office, and effectively what happens is then they have the entire data across all branches, irrespective of the size of the branch and the size of the account. That, of course, would depend on the cutoff limit which the bank, the RBI, fixes. But then I have seen a number of cases where, even very small housing loans or other business loans have been identified by the Reserve Bank as, a diversion as compared to their way of looking at the account. And resultantly, what happens is in all such cases, you have a case where the respective branch auditor gets a letter from the bank which he has audited through, of course, because the Reserve Bank writes to the bank, and then the bank writes to the branch auditor inquiring as to why the specific account was not either provided for as per the IRAC norms of the RBI Master Circular or classified as per the classification which the Reserve Bank thinks. Like, you would have probably classified the account as substandard or standard, and probably, in terms of the way the Reserve Bank looks at it, they could have classified it at a lower this thing, probably, a doubtful 1 or a doubtful 2, or maybe because of loss of security as a loss account. So these are things one needs to be prepared of. In fact, this is one of the reasons I have, fixed certain partner level sign-off checklists before we get on to discussing the regulatory changes during the year. Of course, the mergers of public sector banks, that has resulted in a challenge to the profession in terms of the number of branches under audit going on. And then, of course, when we discuss the master direction on frauds, you would also, be required to match up to the expectations of the EWS and fraud management system which the Reserve Bank has fixed. So like I said, this is a key partner level sign-off checklist. So it does not, in any way say that these are the only checks I would advise all of you to do before signing off your financial statements or the statements which the Reserve Bank expects us to do. But then what I would, these are few important ones which I felt, would help us in protecting ourselves from, making big mistakes, or, probably trying and cover most of the important accounts, so that, in case we do have a query or a notice coming in from the regulator, we are able to answer. Now, this is one document I've always, thought that this would help most of us as auditors. This is, in terms of course, the SA 230. So, one needs to remember that a documentation in excess will never hurt you. But if you, because the ICAI expects us to ensure documentation which is so sufficient, appropriate evidence is what the institute expects us to document. So, I'll get on to this particular slide which we're discussing. So, let's say, the advances probably takes up a major portion of our audit, primarily because when we risk assess the assets and the liabilities in the balance sheet of any branch, you would find that, advances carry the highest risk. So obviously, in terms of the time you devote to the branch, a substantial amount of time would go into the advances part. Of course, my advice to all of you who would go out and branch audit, would be always that, whenever you break up the time, please devote at least 30 to 40% of time to planning and studying and preparing for the branch audit. And then, because, the regulatory changes which happen, the amount of circulars with the RBI issues, more because, it's not a subject which we handle every day. So the preparation both of the team which is going, the partners and the other audit resources has to be a little more than for any other assignment, like probably a internal audit or a corporate or a tax audit. So let's say you visit a branch, you select a certain sample of the advances which you pick up, probably pick up all the SMA 1-2 accounts, all stressed accounts, all accounts, also certain accounts on random basis, some accounts based on the criteria given in the LFAR which got revised last year in 2020. So post the complete review of the accounts which you do, you would probably land up with a certain number of accounts where you have made up your mind that, look, these are the 10 accounts I need to issue an MOC, because as per my understanding of the IRAC norms and other regulatory guidelines, these accounts need to be either classified as a NPA fresh, or probably downgraded to a lower level, or maybe a provision has to be increased. The second type of accounts could be certain accounts where you are kind of post discussion, you decide that okay, the explanations put forward by the branch management together with whatever document they further gave to you, submitted to you, in spite of having an initial viewpoint of classifying that account or downgrading it, you subsequently agree with the management's view and go by either the standard or the asset classification provisioning norms made by the management. So these are the two types of accounts. So my advice in both the cases is that, number one, where you have classified the account as NPA, please ensure that you have the complete documents with respect to the reasons why that particular account you classified is an NPA. You need to have the detailed calculation as to what is the amount of arrears of principal, what is the amount of arrears in interest, and how much was received as of the 31st March 22, and what are the specific clause in the RBI Master Circular or any other circular based on which you are classifying that account as NPA. So why I'm advising you to note it down, write it down and document this is, suppose you get a notice or an inquiry maybe a year or two later as to the reason why you classified that account as an NPA, then you would probably not remember, or if your documentation is not sufficient, you would not be able to answer properly. So please, under the specific custody, ensure that you have the statement of accounts of all the individual loan accounts with you for the entire year or the period, which will help you in identifying those accounts as a NPA or downgrading it, or probably increasing the provision, together with any other document which is required. Maybe also the sanction letter, maybe also certain statement of accounts, maybe a copy of the forensic audit report, maybe a copy of the stock audit report, or any other thing which will help you in doing it. So generally, people do not agree with me that, why do you need to document such a account where I'm I'm probably downgrading it, and after discussion with the management, maybe, a long drawn discussion with the management, it is finally agreed that this account should be an NPA. Primarily because, see, there have been certain cases, including one case with me where, a particular account branch we were doing in branch Jaipur. We classified an account which was a substantial, not a very large account, but a reasonably medium-sized loan account, which we classified as an NPA. And nearly a year after having done that, when we were into the next year of audit, we got a letter from the Reserve Bank seeking an explanation as to why that account was classified as an NPA, because the borrower who was classified as an NPA, he complained to the Reserve Bank that the auditor concerned forcibly classified his account as a NPA. Now obviously he would have, along with this complaint, said that this has resulted in his funds being dried up, because having been classified as an NPA, the bank is no longer giving them further funds. Number two, probably his reputation has taken a hit. Maybe he had a certain goodwill, and once it is classified as an NPA, the goodwill is gone down. So those kind of things. The only thing which helped us in replying to this letter of the RBI was the extensive documentation we had done when the account we classified as an NPA, because we had everything. We had the complete statement of accounts of all the accounts under the specific custody. We had noted down the reasons as to why we thought that what was the amount of arrears, etc. And so together with the document and a detailed reason, when we wrote back to the Reserve Bank, obviously with the help of this particular level of documents, we were able to convince them, and then the matter was dropped. Now the second type of documents which I would advise you is those accounts where you agree with the management's viewpoint after having initially thought that this is potentially an NPA. So these accounts, I think would require you to document it more extensively, because you would probably have formed an opinion after discussing it, but maybe certain youngsters have found that they get influenced, they get pressurized when they reach the branches, and probably after requests by the branch head and maybe higher administrative heads, youngsters do kind of agree to the reasons without actually that reason being justified in retaining the standard account. So friends, those of you who have this, I would advise all of you that in case you have an issue, please discuss that with some other senior with you, and after you're completely maybe a professional, maybe even me, if you have a doubt, you can always call me. But then the main issue is that you need to be totally convinced that, look, this is not an NPA. If that is the case, your viewpoint was incorrect, then it's perfectly fine if you do not issue the MOC. But in case there is a doubt, you need to be completely thorough in your understanding of the issue. Discuss it with a few other auditors, and then in case you feel that the MOC needs to be issued, issue the MOC, and in case it is dropped, then document the reason in detail. Do not just say that, okay, I have certain members came to me with such notices from the respective banks stroke RBI, and then the same thing, the query was why was this account not classified? These were the number of accounts which the Reserve Bank identified as NPA, which they did not, the branch did not classify those accounts as NPA. So In all such cases, the first thing one needs to do to be able to reply is we should be able to justify the reason for having dropped that. Now, most of the cases members were found that, all they had done was in the advance sheet written, okay, satisfied, that kind of thing, So that will definitely not help when there is a issue. And then probably, 1 or 2 years down the line, if you try and go back to the branch concerned, it will be very difficult for you to maybe, the respective branch managers already got transferred. So, it will not be the same as it was earlier. So, my friends, I think, this slide, we can conclude by just saying that, wherever you are either issuing an MOC or not issuing an MOC, ensure that you have the statement of accounts of all the loan accounts under that specific custody, where, it was potentially an NPA, or you classified as an NPA, or it was regularly in the SMA 1-2 category, or maybe reported as a potential fraud by the Reserve Bank, and also those accounts which you are commenting in the LFR as per the revised LFR 2020. Certain other checklists that we can quickly run through. One is the identification of the red flagging of accounts. See, if you see the master direction on frauds, which is issued by the Reserve Bank of India, and there's also another publication of the institute which talks of the early signals of frauds in banking sector. So these are the two important publications which will help you in the master direction or fraud, or the early warning signals which are given there. There are nearly 43 to 45 parameters where the Reserve Bank has identified and said that, look, these are the parameters based on which can be considered as an early warning signal, and which probably will help you in identifying that, these are the accounts which are susceptible to fraud. So based on this, different banks have fixed different levels, and then they red flag them as being susceptible to frauds. So where probably they say that, look, there are a number of instances where, those parameters listed in the master direction on frauds, that which feel, make the management feel that probably these are susceptible to fraud. So, and based on that, based on their understanding, I mean, this is not rule-based unless, unlike the IRAC norms. I mean, based on their understanding, based on their own internal guidelines, they red flag them. And then, so as an auditor, what I would advise you is, as soon as you visit the branch, please ask the branch concerned to give you a list of the red flagged accounts. They may not probably have access to the Central Fraud Registry portal, based on which, the red flagged accounts can be identified. If they do not have that, you can ask them to help you access it through the regional office or any other administrative office. The Reserve Bank advises that in case an account is flagged as a red flagged account and the red flag is not removed, the red flag would be removed when those parameters which are identified through the RBI Master Direction on frauds, they do not exist in the account any longer. So, then that becomes a normal, healthy accounts. But then if those conditions persist, then the red flag remains, and then the Reserve Bank says if the red flag account flag is not removed within 6 months, the bank concerned has to report it either as a suspected fraud or as a fraud. And in case it is reported as a fraud, obviously all of you would be aware that then there would be some provisioning requirements in terms of the RBI Master Circular of 1st October 21. The next, this thing is, I think, based on the same Central Fraud Registry portal, all banks have been advised by the Reserve Bank of India that in respect to all accounts of 100 lakhs of above, so, any account with a limit of 1 CR and above, the banks are required to use the Central Fraud Registry portal for credit appraisal. So in fact, I've been told certain banks have fixed very lower limits. Like, the Reserve Bank has prescribed 1 CR. Some banks are also using the same to be as 1 lakh. So, any limit which is sanctioned above 1 lakh, they use a CFR portal. So the CFR portal, primarily what it does is, once, let's say, an application comes to the bank, they check, they need to check whether, this is an account which is probably red flagged by any other account, etc. So what the RBI has advised is that go on to the CFR portal before you appraise the limit, and then once you find that the account is healthy, you can do it. But as auditors, I would advise you that, all accounts which you are reviewing, please ensure that, you, along with the help of the management, because the branch concerned may not have access to it, access the CFR portal in respect of all those accounts which you are reviewing, the large accounts, and also specifically the potential NPA, and those accounts which are regularly going in and going out of SMA 1 and SMA 2. Take screenshots of proof that you did carry out this exercise, and wherever you find that, there is something negative, please report it in the LFAR. And also, in case you find that, out of the parameters listed in the Reserve Bank of India Master Directions, in case you find there are a number of conditions which exist in a particular account, but you probably do not need to downgrade it. So those conditions, those listed, you can report it in the LFAR report which you issue. The third partners level pre-sign-off checklist would be that, ensure that in respect of NPAs, I think, broadly for us as an auditor, it is the security which is important. So security, obviously, both the movable and the immovable property. Immovable property, earlier, if you remember, we used to depend more on the title deeds and the valuation of properties. But then those title deeds, it used to be a very tedious job to, ask the branch or the advances in charge to get the respective title deed, ensure that they are in the possession of the bank, etc. So now, the new system is, it's been running for a few years. All these title deeds, both immovable and movable properties, they are available on the CERSAI portal. So again, access to the CERSAI portal you'll have to make with the help of the respective branch management. And because not all branches of all smaller sizes may have access to the CERSAI portal. And then once you access it, because in the documents you would have the CERSAI registration number of a particular borrower. So once you enter that in the CERSAI portal, you would have access to all the title deeds, the movable and the immovable property which is there. So now again, as proof of you having done that, you can take printouts of the same or maybe screenshots. So, but the final matter is that one needs to document what one is able to do, one is done, because what the institute says is that your documentation, it should be such that post maybe 4 or 5 years, if some other as an independent reviewer comes in, so what do we he should be able to take understand the review processes you went through, the procedures you took, etc. So primarily that. I have a question on that from Vitesh Gandhi from Bombay. He says, sir, even in all sanction of limit of more than 1 CR, status of CFR needs to be mentioned in the proposal that the branch has checked the same. Thanks, Vitesh. I think, this is a clarification. So, even in the proposal, the proposal needs to have that specific noting by the branch management that they have accessed the CFR portal and found it to be healthy. Then, of course, this is in respect of very large accounts. I think most of us would not have these accounts, but then as an information, with respect to borrowers with limits of 100 crores and above, one needs to be registered as a legal entity identifier. This normally LEI is valid for 1 year. So as an auditor, in case you do have an account of 100 crores and above, please ensure that it is alive, and if it is expired, please report it in the respective advances review part in the LFR. Then, of course, these I think most of us have been doing, but then I always find that this is something which is probably godsend by the IT system the banks are running. So the CBS or the Finacle or whichever CBS software the respective bank is running, they have coded, let's say, controls maybe up to 5,000, 10,000 after discussion with the management to mitigate all the risks. But then what all softwares which the CBS softwares with banks run, they have the system of throwing out an exception report, primarily to throw out any exception to the rules which have been embedded in the respective CBS software. So generally the management is the branch management is required, the branch manager is required to, at the end of the day, as the day-end process, to ensure that the exception report is generated, reviewed, and then signed off. In a few banks, this is part of the concurrent audit report. So, for us as an auditor, I would advise you to definitely take the printout of the exception report as of the year end, which is 31st March 22. Ensure all exceptions they are not affecting your financial statements, your advances, your NPA classification, provisioning, any of the assets, liabilities, or the income expenditure. So primarily, the exception report as of 31st March 22 is a must. And other than that, I would advise you that you please do take the exception reports for a few random dates and check whether compliance of those random dates has been done. CRILC report, of course, I would suggest that, with respect to the limits above which the banks are reporting SMA 012, at least in respect of those borrowers which are regularly being classified as SMA 1 and 2, or, being classified as SMA in one period and then probably getting regularized and then again coming into the SMA 1 or 2 category. So this, I would advise all of you to, make a list of all the SMA 1-2 accounts during the current year, and ensure that the list of those accounts is part of the list of advances which you or your team members would review thoroughly. Because SMA 1 and 2, or probably even SMA 2 or maybe 1 also, they could potentially be potential NPA, or they could be possibly have been subjected to evergreening by the respective branch. So one needs to ensure that those SMA 1 and 2 accounts which are not being classified as an NPA as at the year end have not retained the standard asset category because of any evergreening process which may have been undertaken by the branch concerned. I think this is normal, but then please ensure that you visit the rbi.org.in. Ensure you remain updated, because the Institute's guidance is up to February 22. So in case you visit the branch in the current week or the next week, do log into the rbi.org.in and ensure that there are no new circulars which the Reserve Bank of India has issued. in all the circulars, master directions, other notifications with the Reserve Bank issues, I would ask you to download the FAQs, especially on the MSME and the primary sector lending, because that will give you a clear, easier way of understanding the very important subject of MSME, primarily because the resolution framework to when you see the compliance during the current year, as we will discuss in the next 1 hour, we will see that the classification of accounts as MSME as of the 31st March 21 becomes very important. So that FAQ on MSME, which has been updated up to 1st October 21, is available on the RBI side. Download it and take it as part of your so these are master circulars which are still valid as of 1st July 2015. No, of course, there would be some circulars issued on this, like the statute and other restrictions. There is a circular during the current year, even CRRs, SLR, etc. So Basel III also. So these keep getting updated, but the master circular has remained the same. There are 3 circulars, master circulars, which are issued during the year. In fact, a few years back, when the Reserve Bank had announced that they would no longer be issuing master circulars and master directions would replace them. So I was kind of surprised that 3 master circulars afresh were issued during the year. So these 3 master circulars, all of them are important to us. Number 1, housing finance for all of us who would do a large housing portfolio. Most branches have that. Then guarantees, most of us have these off-balance sheet items, and also most importantly, the 1st October 2021 circular on IRAC norms, which changed 1st July 2015, right? Master directions, you can just get into the RBI site and have a look, but then I've just listed them for your help. For the central auditors, there's a new master direction on financial statements, presentation and disclosures issued during the year of 30th August 2021. These are the 2 important FAQs, MSME, which is updated up to 1st October, and also primary sector lending, which will also be relevant once you get into the agriculture and other loan review part. Things to carry, I think you need to carry everything to your branch so that you and don't forget the digital signatures, which are the thing, and also probably all the master circulars, all the circulars which you carry. Also, just in case you lose out on data, etc. So I would advise you to keep it in some media, probably a pen drive, etc. So that in case you're at a rural branch where you're not able to access the RBI site, this would help you. This is the last kind of checklist for us. Please ensure that there is a synchronization of the 3 reports you would issue as an auditor. 1, the LFAR, 1, the second, the main audit report under the SA 700 series, and then of course the IFCO-FR report. So please ensure that whatever you're reporting is synchronized. So sign off all the 3 reports together. The most common problem has been in the past years has been that LFARs have reported certain issues which was in contradiction with the main audit report, primarily because LFARs had certain reports of advances which probably the auditor has reported that these should have been classified as an NPA, or the overdues was more than 90 days, or maybe the stock statements have not been received for the past 12 months. So those kind of reports makes it contradictory to what you are reporting in the main audit report, where you've not issued an MOC. So just as normal sign-off, pre-sign-off checklist that all of them are synchronized. Of course, the guidance note on audit issued by the ICO of February 22, you would need to carry. Now let's get on to the regulatory changes which happened during the year. Every month the RBI comes out with a number of circulars. there are around 21 circulars which are important to us, which were issued up to probably yesterday, which are important to us as branch auditors and also auditors, central auditors. If I try to break up or categorize these circulars, one would find that, one, they relate to the resolution framework because of the COVID, which struck all of us in April 2021. Then there is certain changes in the MSME. There are circulars with respect to the current account circular which came out last year. Certain relaxation in that. So we'll try and discuss that. But most, and of course, the Master Circular of 1st October 2021. So these are the circulars which are relevant to us. Probably this presentation or the webinar, the taxman would make it available to you as auditors, so you can take help of the list I have created. But I'll discuss, all of them except those which are not relevant. But out of the 21 circulars relevant to us, I'll be discussing most of them. Now, the first circular we can quickly run through is the 7th April 2021. I mean, this is a circular which got complied during the last year's audit of FY 2021. This was more as an offshoot of the Supreme Court ruling of the 23rd March 2021 last year, where, the Supreme Court ruled that there should be no charging of compound interest, interest on interest, or penal interest with respect to installments, etc. So this of course got covered for the period 1st March to August. This of course got covered because all the banks gave credit to the affected borrower's account for the year ended the 31st March 21. So this was complied with, but the RBI circular of 7th April 2021 was in compliance with 23rd March 2021. In some one-off case, if this has not been done during the current year's review, if you feel, then probably you can ensure that the respective borrower's account is credited with such compound interest, interest on interest, or penal interest during the past year's period of 1st March 2020 to 31st August 2020. Now we come to the first restructuring circular. There are, I think, three important circulars. Two of them, in fact, are dated 5th May 2021. This circular, restructuring circular I'm addressing right now is with respect to the MSME, and then there is another which relates to the personal and other small businesses. So effectively this year, because of COVID, the Reserve Bank has ensured that, all small accounts are also restructured together with personal loans also. So, as we discuss the next one, we would find it. Before we get on to this, I think, we need to remember the notification of 26 June 2020, where, both the conditions for a micro, small and medium need to be complied with. That is, the new limit is 1, 10 and 50 for micro, small and medium, and together with a turnover of 5, 50 and 250. So, as auditors, one would need to ensure that, as of 31st March 21, if the investment in plant and machinery exceeds 50 CR, I do not allow the branch to give them the benefit of the resolution framework 2, and also if the turnover, as per your information or maybe as per the GST returns, you ask the branch to share with you, if it exceeds 250, the resolution restructuring benefits are not given to the respective the same. Now there are in the 5th May 2021 with respect to restructuring of advances of the MSME sector, there are 8 important conditions. Some of them are common as they came out in the resolution framework of 1. There is only one condition which is new, and otherwise broadly they are the same. So first is the aggregate exposure across the banking industry, both fund-based, non-fund-based, needs to be less than 25 crores. But Post 4 June 2021, this limit has been increased to 50 CR. The second condition is a common condition, that the borrower's account needs to be a standard account as of 31st March 2021. So in all the restructuring circulars which we will discuss, you will find that, this is a common condition. The borrower's account needs to be a standard account as of 31st March 2021. Third, it has to be an MSME as of 31st March 2021. Now, this is important because that is why this definition, which we referred to in the previous slide, becomes important. So please ensure compliance with this, and then because of that, one would be able to ensure compliance of those restructured accounts with condition number 3. Condition number 4, GST registered, and if it is not GST registered, it should be GST exempt. Fifth, common condition again this year, except in respect of one particular condition, that none of these borrowers should have been restructured as per the earlier restructuring framework, which happened during the resolution framework 1 last year. And then sixth condition is that the restructuring needs to be invoked by 30th September. Sir, again, friends, all of this condition is again common. In all these restructuring circulars, you would find that the date of invocation in all three circulars is 30th September. So effectively, the branch, if it has invoked any restructuring post 30th September, you can strike that off and downgrade the account as NPA, because banks are not allowed to invoke the restructuring post 30th September. So standard as of 31st March 2021, that's a common condition. The invocation by 30th September 2021, that's a common condition. And the third condition of being implemented within 90 days from the date of invocation, that's again a common condition. So, these three conditions, you would find that, all of them, all circulars talk of the same. So effectively, from 30th September, if I calculate 90 days, probably that will turn out to be 30th December. So post 30th December, there can be no implementation of restructuring in any of the branches you audit. Similarly, there can be no invocation of restructuring post 30th September 2021. Eighth condition is the new condition, which says that if the borrower is not registered in the Udyam registration, then the registration on the Udyam registration.gov.in has to be completed or implemented as before the date of implementation, which is 90 days from the date of invocation, the last date being 30th September or 30th December, which is the date of implementation. Of course, fallout provision is that the lending institutions need to provide for 10% extra for the residual debt. So effectively, this is with respect to the 5th May 2021 circular of restructuring, which had three common conditions, which you would find in common when we discuss the other circulars. This is a clarificatory circular which came out with respect to MSME, with respect to certain information being valid up to 31st December 2021, primarily to help borrowers who had applied in the MSME to be eligible for the restructuring circular of 5th May 2021, because 31st December 2021 would effectively be the last date of implementation of any restructuring. Now, 7 July 2021 RBI circular, this gave a new definition to the MSME by addition of retail and wholesale trade. I think, if you remember that earlier, one point of discussion with the branch management would always be that, look, how come you are restructuring retail trade, small shops, wholesale traders? I mean, they can't fit into the classification as an MSME. Now, this 7 July 2021 circular, of the Ministry of MSME, it decided to have, in the NIC code 45, the wholesale retail trade of motor vehicles and motorcycles. And if you see 46, 47, it says wholesale trade except 45, 47 retail trade except 45. So literally covering the entire gamut of retail and wholesale trade. So this year you could see a number of accounts in retail and wholesale trade getting restructured in terms of the 5th May 2021 circular. But friends, I think the primary condition in all the resolution framework 2 restructuring circulars which have come out is that the primary condition is that the stress on such borrowers on their ability to repay the principal and interest to the lenders should happen because of COVID. Now, so that's a difficult ask for the auditors to probably identify. It's not going to be easy, but then generally if you see that because the kind of impact COVID had during the months from April to maybe May or June, I think all of them would have got stressed because of the lockdowns and various other impacts. Then we come on to the next restructuring framework, resolution framework 2 restructuring circular of 5th May 2021. But this relates to one, individuals, and second, to small businesses. So it does not relate to MSME because that has already been covered under the earlier circular of 5th May 2021. Of course, it applies to all, and this circular has two parts. Part A of relating to individuals and small businesses, and B, which is respect to working capital support to small businesses where resolution plans had been implemented previously. So in Part A, you would still have that condition that in case you were restructured in resolution framework 1, you would not be eligible for resolution framework 2. But in Part B, the working capital support, that is an exception to that. So when it comes to restructuring individuals and small businesses, these are the three borrowers who are eligible. One, individuals who have availed personal loans. If you remember, personal loans were never restructured earlier. You would never have a loan against property or a personal loan against salary, etc., being restructured by banks, primarily because there were no businesses based on which you could restructure. So this specific circular gives us that option of restructuring individuals who have availed personal loans. Second, individuals who proprietorship firms with aggregate exposure of less than 25. Small businesses other than MSMEs, again, exposures of less than 25 crores. So the conditions here are, number one, should not have been restructured under first resolution framework. Second, standard as of 31st March. As I said earlier, invocation date should not be beyond 30th September and implementation by 90 days. So these are common conditions, easy to remember. The second part of it is that if where it had been implemented earlier. So for proprietorship businesses of with aggregate of less than 25 crores and small businesses other than MSMEs with aggregate exposure of less than 25 crores. Here, what the Reserve Bank has said is that the working capital sanction may be reviewed by banks as a one-time measure. That is, the working capital given to such businesses may be, the limit may be increased, the margins may be decreased, the interest could be increased, they could get any benefit. Based on what condition? Again, that, the decision needs to be taken by 30th September, and here it is not the date of implementation. What it says is that the margins and the working capital limits need to be restored to the earlier levels by 31st March 2022. So as of 31st March 2022, you would have the same margins and working capital limits. Regulatory restrictions, they've just revised the amount from 25 lakhs to 5 crores. Not very relevant to us as branch auditors. Then derivative contracts, there is a small clarification that, this particular condition will not be treated as restructuring requiring a downgrade. That is, a change in the reference rate necessitated due to the transition from LIBOR, other conditions remaining the same. So in this condition, it will not be treated as a restructuring, and the account would retain the standard asset category. There were certain financial parameters which were fixed, tougher financial parameters. Now here, because of COVID, the Reserve Bank of India deferred these 4 financial parameters compliance to 1st October 22, but they said that the total outside liabilities and total tangible net worth ratio compliance, the sector specific threshold levels need to be complied with up to 31st March 22. Then there were some circulars which came out during 2021 with respect to non-opening of current account by banks, especially where there was in a CCOD facility. Now this year, because of probably the discussion and the difficulty the management had, felt that not opening the current account restricted their way the account could be operated. Although the Reserve Bank and the banks felt that allowing current accounts to be opened by borrowers who already had a CCOD facility, was a way in which the funds could be diverted or frauds happened. And most of the forensic audit reports found that divergence happened because of the existence of current accounts happened, because of which in FY 2021 we had this case of these circulars coming out and restricting that the borrowers with a CCOD facility, no bank could open a current account, and in respect of others, they said that the lenders could open it subject to certain conditions. During the current year, what the Reserve Bank did was they primarily they relaxed the earlier regulations and said that exposure to the banking system, if it is less than 5 crores, then there would be no restriction on opening of current accounts or on provision of CCOD facility by banks. So small borrowers, they said that the relaxation is there, but then above 5 crores, that restriction would remain. That it would be the current account could be opened only by those with aggregate exposure of 10% or more, or in case nobody has a 10% exposure, then it would be by lenders who had the highest exposure. Let's get on to the next important Master Circular of 1st October 2021. Which changed the RBI Master Circular of 1st July 2015. Now, there are some changes which change the way an account is classified as an NPA, but not too many changes. If you do a compare doc kind of exercise on both the circulars, not too many changes. But then those changes I would discuss during this. Number one, this para 5.7.2 primarily gives the option to banks that the provisioning rates which have been prescribed are primarily from the regulator, the regulatory minimum. So what the Reserve Bank said is that the banks are encouraged to make provisions at higher rates based on the stress sectors. So, what the banks have been advised that they need to review all the sectors of the economy at quarterly levels, assess their risks, and based on the risks they perceive in that particular industry, increase the provisioning rates of that, then probably review it the next quarter, and if they perceive again that the risk has gone down, then maybe fall back again on the regulatory minimum. So but for us as branch auditors, we would need to go by the closing circular which the banks would issue to us as auditors, and then once with that, we would need to ensure compliance with the provisioning rates specified therein. But there are some clarifications of November 2021, and also with respect to SMA 0, 1 and 2. Primarily, for us as auditors, like I said earlier, what is important is all those accounts which are classified in SMA 1 and 2, which are hovering around SMA 2, so as to enable us to ensure that none of them are under the NPA category, or they have not been evergreened. This November 2021, 12th November, it primarily converted what was there in the figures of 1 to 30. It probably, there was some interpretational issues coming up. So they said that SMAs 0 would be all those accounts where the overdue is up to 90 days. Similarly, 1 and 2, 30 to 60 and 60 to 90. One change which para 4.2.21 made is with respect to the way credit card dues are to be classified as NPA. The 2021 Master Circular gives us a shorter time to classify an account as NPA as compared to the 1st July 2015. The 1st July 2015 specified that the minimum amount due would be, the account would be treated as NPA in case the minimum amount due is not paid fully within 90 days from the next statement date. And the next statement date would normally be in the next month. And the current Master Circular of October 21 says it will be treated as an NPA if the minimum amount due is not paid fully within 90 days from the payment due date mentioned. Normally, payment due date is the same date in which, let's say you get a credit card statement on the 11th of March, then probably your last date would be 21 days away, which will be 30th or 31st of March. So 90 days from 31st March, if the minimum amount due is not paid, it will be classified as an NPA. Earlier, it would be, the next statement date would be, which could have been 11th April 2022, and so 90 days from 11th April. So probably, it has resulted in shortening of the NPA classification period by around 10 to 15 days. Now, this is one change which probably does away with a lot of discussions which we as auditors generally would have with the management, because the management was always of the opinion that, let's say, 90 days or more than 90 days is getting over on the 31st of March 2022. So since, it gets over at business time on that date, or maybe, 12 midnight on that date, the date on which asset classification should be made should be the 1st of April 2022. I mean, this was a thought process of many branches, certain administrative officers who did not want certain NPAs. So that was the best way. So let's say there's a large borrower, where the overdues were not paid up to 31st March. So this type of contention would come in from the management that, look, up to 31st March 2022, I had the time, so I'll classify it on 1st of April 2022. So this RBI has clarified and said that, the lending institutions need to classify an account as an NPA or as an SMA 012 as part of their day-end process irrespective of the day on which the day-end process happens. So effectively, what will happen is that, let's say, the 31st of March 2022, the day-end process would obviously happen tomorrow, because tomorrow is the day when they would handle that kind of this thing. So irrespective of it happening on first, the date of classification would be the date for which the day-end process is happening, which is the 31st March 2022. Similarly, let's say every day there's a day-end process. The day-end process is happening on the 7th of April 2022. And, they find that on that date, the certain overdues are there for more than 90 days, or it is out of order for 90 days. In all such cases, the system-based asset classification would classify such an account as SMA or NPA as a day-end process. So that's, would do away with all the confusions which we had earlier. As a result of what we discussed in the earlier slide, which is a classification of an account as an SMA or an NPA as part of the day-end process, the RBI as not as part of the 1st October 2021 RBI Master Circular, but as a clarification on 12th November 2021, made certain changes with respect to out of order. Number one, there are some questions which I've got from certain members attending this. I think, let me finish this because I have 20 minutes for the webinar, but let me finish this important master circular. Then I'll try and resolve all your queries. And in case, I'm not able to do it, I'll leave you with my mobile number. You can call me in case, your queries remain unresolved. So getting on with this, if you remember, out of order conditions for a CCOD account to be classified as an NPA was, either of these three conditions getting ticked off. One was outstanding CCOD remains continuously in excess of for 90 days. And also, if, just as to reiterate that, whenever we talk of a term loan or any other similar loans, the account would be classified as an NPA when the overdues are for more than 90 days. And when we talk of CCOD or an out of order, then it would be for 90 days. So that's a, broad difference between the time when we classify an account as an NPA. The second condition here, it talked of the principal operating account. So what the RBI has done is they said, this respective CCOD, and it also had one condition that if there are no credits continuously for 90 days as on the date of the balance sheet. So, this many branches or the banks would read it as, this can happen only as on the date of balance sheet, which is the 31st March. So it cannot be done on any other day. But now, since NP classification would be day-end process, the RBI has deleted this part and said that, in case there are no credits continuously for 90 days as on any day, the day-end process is happening, then together with the first condition, it would become an NPA. And the last one, where outstanding balance be continuously in excess of drawing power or sanction limit, but the credits are not enough to cover the interest debited during the same period it said earlier. The same period would effectively, this was again something which always used to be a matter of discussion. Now they've deleted the same period and says previous 90 days period. So effectively, let's say I'm doing it today, 31st of March 2022. That means the previous 90 days period would be previous from today, including today, because today is to be included in the as a day-end process. And if it happens on any other day, working day of the bank, then the previous 90 days period would be on that day. So now, the account can be classified as an SMA or NPA on any working day. So, it would not require the banks to do that exercise, although it was done by a few banks earlier also. But then it would not be required to be done at the weekend or a fortnight end or a month end. Para 2.1.3 was again one para in the RBI Master Circular of 1st July 2015, which used to be discussed primarily because, although as per our understanding, it related to overdues with respect to term loans, but most branch managers would fall under this, try and cover their CCOD overdues by saying that, CCOD, the interest due and charged during any quarter, this para says that, it has to be serviced fully within 90 days from the end of the quarter without, seeing those three conditions of out of order. But now the RBI has clarified and said that, in case of interest payments in respect of term loans, so here 2.13, they've clarified that it relates to term loans, that the account will be classified as NPA if the interest applied at monthly intervals, which is the specified rest, is due for more than 90 days, because that is the period when term loan would be classified as a NPA. Another clarification of 12th November 2021 is, that loan accounts classified as NPAs need to be upgraded as standard only if the arrears of interest and principal are paid by the borrowers. Together with this, there was another clarification which said that, the arrears of interest and principal, if in case there are a number of accounts, would not be possible that, if the arrears of interest and principals are recovered in one account and not recovered in the other, that we can upgrade that account as a standard account. We would require that account, all the accounts, loan accounts of the borrower under the custody to be fully recovered in terms of the overdues of principal and interest. This is again a clarification of the 15th November, February 2022 with respect to the 1st October 21 RBI Master Circular. So basically it said that definition of out of order would also be applicable to loan products which are offered as an overdraft facility but not meant for business purposes and which entail interest payments as the only credits. So if you remember that, where loan against property and other personal loans where the bank would say that, the only thing one needs to do is recover the interest. So now the RBI is clarified that, these accounts will fall under the definition of out of order because here they are offered as an overdraft facility against a specific security and they are not for business purposes, but which entail interest payments only. So, we will need to be careful, especially when reviewing such type of accounts. And another clarification under the same 15th February 2022 is the previous 90 days period is, just a clarification which was clear, shall be the inclusive of the day for which the day-end process is being run. So effectively, let's say I do it today when the bank runs the day-end process for 31st March 2022 on 1st of April. So it will include the day for which day-end process is done. So when we talk of out of order, I will include 31st March. So I will have to probably take the period from 2nd of January 2022 up to 31st of March. I'm taking this purely just while I'm discussing it. I've not calculated it, but I presume that. But logically, the only thing one needs to be careful is include the date on which you are classifying the account as NPA. So if it is for more than 90 days in respect of term loans, So obviously you'll have to include one more. And the last one is in case of borrowers with more than one credit facility, the repayment in all the credit facilities would need to be recovered. So friends, I think, this was about all the regulatory changes which happened during the year. Again, before I close and start taking up the queries of the members, I would request all of you to please ensure that, you download all the respective circulars, review all the circulars, and once you are at the branch, please ensure that, the latest circulars, if issued by the Reserve Bank, post issue of the guidance note or the post, the last time you visited the website, they are downloaded, and if relevant, please ensure compliance.
Thank you, sir. Wonderful deliberation.
Thank you. I'll take up, I have this in the chat box. I'll take up the Vitesh, I've already answered, right?
I've shared with you the queries as well.
Okay. Yeah, there's one query. I don't have the names, but I'll, take that up. One query says extension of moratorium period for principal repayment of term loan, would it amount to restructuring? Friends, the moratorium period can be extended as long as the door-to-door tenor, that is, if I had given the term loan for a period of 5 years and I extend the moratorium and then revise the balance EMIs or the term loan installments to ensure that the door-to-door tenor remains the same, it should not amount to restructuring, because the general restructuring is that it should give them a benefit. And, of course, unless you're talking of, the large accounts with respect to what was referred to in the 1st July. In case you still have doubts, you can call me. This year, due to the extension of due dates for IT returns, can it be a reason for non-renewal of CC account within 180 days? That, friend, would not be a reason, because, renewals can be done. So effectively, you have a period, you can do a short review at least twice. So that should not be one of the reasons for not renewing the account as a CC account. Sir, if the MSME slips to NPA after the 1st of April 21, it shall be considered as standard this benefit available to non-MSME. If MSME slips to NPA after the 1st of April 21, yeah, it shall be considered. I'm not very clear about whoever has sent this query. Maybe you can clarify, or maybe write to call me up. I'll do it. And then what is the residual debt in the resolution framework 2? To my understanding, resolution debt, residual debt in the resolution framework 2 would be, all the debt which has not been restructured by the bank. So let's say, there was a total loan to the borrower of 10 crores, and the only account which was restructured was with respect to a term loan of 2 crores. So that would be this, and the rest of it, which is 8 crores, which is the residual debt, one would have to provide for 10%. Does capital budgeting an important part in banking? Yes, it is important part in banking, but I am not sure how relevant would it be for us as branch auditors. Maybe, if you're the central auditor of a bank, you could get into it, but as a branch auditor, I'm I would not say it would be relevant to us. Whether a trust account can be restructured, now they talked of individuals and small businesses other than MSMEs which can be restructured. So, if they fall under the definition, you can have a look at the 5th May 2021 circular, and in case it is carrying out a business, the small business, then less the aggregate, it has taken a loan, then definitely it can be restructured. NPA in the case of agriculture advance after 3 years of sanction. Whoever has asked this, I think, agriculture loans require you to assess various factors. Number one, what is the cropping season? So for that, I'll suggest that, you take a list of the cropping season wherever you are from the SLBC there. And number two, whether it's a Rabi crop or a Kharif crop. Third, whether the farmer is a multi-cropping farmer or a monocropping farmer. And fourthly, because the Master Circular or any of the RBI circulars are clearly, they have not given a rule-based method of identifying agriculture loans as NPAs. But I would suggest that, you carry out a few things. Now, broadly, if I give you a thumb rule, that from the date of withdrawal, 1 year is generally treated by the banks as the due date of repayment. So let's say, for summer season crop, he has withdrawn the loan on 2nd of March 2021. So the due date of repayment would be 1 year from there, right? And post that, if it's a short duration crop, I would have to add 2 crop seasons, right? And if it still remains overdue, it would become an NPA. If it's a long duration crop, 1 crop season. So, it will be specific case-based when you can identify the account as an NPA. But very broadly, another check you can do is download all the agriculture loans and maybe, identify all accounts where the principal, where the loan outstanding as of date, as vis-a-vis the loan given is, let's say, double, then obviously, that as a thumb rule, you could see that, those accounts are NPAs. Otherwise, 3 years broadly should give you this thing, but I cannot state with, I cannot say you're correct if you say that, if it's just 3 years, it will be an NPA. You'll have to go case to case. When was the loan given? When did he withdraw it? What was the season for which he took the loan? So you'll have to go into it. What is Central Fraud Register and CERSAI? Like I said, the CFR portal is a separate portal. Similarly, the CERSAI portal. So CFR portal gives all banks access to a specific borrower. So, they are able to identify, they are able to see, let's say you're doing State Bank of India, you get into the CFR portal with the help of the bankers, because you will not get access into the CFR portal, you will not have the login ID. But when you get into the CFR portal, you will see that, you will be able to see the RFA and the other status of all the other banks also. So it will give you a clearer picture of the health of that particular account. CERSAI portal gives you an idea of the title deeds, the properties which are charged, the details of the movable and the immovable property. Again, once you visit the branch, once you see a portal, I think it will help you access that. What aspects in exception reports are to be reviewed with regard to MOC or LFR? So So, see, the exception report will give you various exceptions, even exceptions which are not relevant to you as an auditor. But those exceptions where, you are able to identify that, look, these are where probably it states that, the interest has not been booked, or any other exception which is affecting your income expenditure, maybe also the asset classification. So if you are able to identify such exceptions in the exception report, note it down, discuss it with the management, and in case required, issue the MOC. LFAR, generally it would not be required, because LFAR is more from the point of view of reporting to specific queries of the form which is given to you. I think those are the questions which I had, Bhavna. I'm not, if you have any further question, you can do it.
Yes.
Otherwise,
these were the only questions that
right.
were asked.
So thank you everyone for hearing us out, and always open to any query which you may have subsequently. Thank you, Bhavna from Taxman, and also thank you, Taxman, for giving me this opportunity.
Thank you.
Thank you. And happy auditing.
Thank you, sir.
Thank you. Bye-bye.
Okay, bye.